2 years ago, I sat down with a spreadsheet and asked one question. If I had $50,000 to invest, where would it actually make me more money? Real estate or the stock market? What I found wasn't even close to what I expected. In the next 10 minutes, I'm going to show you the real math nobody talks about. Not opinion, not I like real estate because you can touch it. Actual numbers on a spreadsheet. By the end, you'll know exactly which one wins. And more importantly, which one wins for your life. Here's the thing. Everywhere you look, someone's telling you real estate is the only path to wealth, or that index funds are all you need and landlords are suckers. Both sides have a story to sell. But behind both stories is a math equation most people never actually run. So let's run it together. Imagine two people. Both have $50,000. Same starting line, same 30-year horizon. Investor A buys a $250,000 rental property, puts 20% down. Investor B drops that same $50,000 into a low-cost S&P 500 index fund. Who ends up with more money? Let's follow the numbers. Investor A's $250,000 property. They put down $50,000. The mortgage on the remaining $200,000 at 6.5%, about $1,264 a month. Property taxes, maybe $250. Insurance, another $80. Maintenance, plan on 1% of the home's value a year. That's another $200 a month averaged out. Before this property makes a single dollar of profit, Investor A is spending roughly $1,800 a month just to hold it. Now the good news, they rent it out for $2,200 a month. That's $400 of monthly cash flow and $4,800 a year. But there's more. That $250,000 house. Historically, real estate appreciates at 3 to 4% a year nationally. Year one, the property gains roughly $8,750 in value. Plus, the tenant pays down the mortgage, about $3,000 in principal that first year. Year one total, $4,800 cash flow plus $8,750 appreciation plus $3,000 equity paydown. That's $16,550 on a $50,000 investment, a 33% return. Here's why this matters. That return doesn't come from genius. It comes from leverage. A 20% down payment means you control a $250,000 asset with $50,000. That multiplier is the real estate superpower. But it's also the trap. More on that in a minute. Investor B, same $50,000, dumped into an S&P 500 index fund. No tenants, no toilets, no property tax bills. Historical S&P 500 return? About 10% a year. Let's call it 7% after inflation. Year one. $50,000 earns $5,000. 10%. No leverage, no debt. Just compound growth. Year two. That $55,000 earns 10% on itself. 5,000 year three. 60,000 earns $6,050. Slow, boring, relentless. After 30 years, that $50,000 untouched at 10% becomes roughly $872,000. No tenant phone calls, no property manager drama, just time and math. Here's why this matters. The stock market wins on simplicity and liquidity. You can sell tomorrow if you need cash. Real estate? You can't sell a bathroom. That illiquidity has a cost, one most people never price in until it's too late. Let me tell you about that spreadsheet. When I first ran these numbers, real estate won on paper, by a lot. But then I added 3 things most calculators skip. 1. Vacancy. The average rental sits empty about 1 month between tenants. That's $2,200 of income that just disappears. Over 30 years with new tenants every 2 to 3 years, that's real money. 2. Major repairs. A roof doesn't fail every year, but when it does, and it will, and you're writing a check for $12,000 to $15,000. New HVAC, $7,000. Over 30 years, I estimated $40,000 to $50,000 in big-ticket repairs. 3. Your time. Self-manage and you're working a part-time job you don't get paid for. Hire a property manager and they take 8 to 10%. On $2,200 a month, that's $176 to $220. Gone every month. Here's why this matters. When I subtracted vacancy, repairs, and management, the 33% year one return dropped closer to 18, still great, but not the magic number they sell you. Remember leverage, the reason real estate can produce returns stocks can't touch. But here's what they don't tell you. If your $250,000 property drops 20% in value, and yes, that happened in 2008, it happened in pockets in 2020, it can happen again. You've lost $50,000. Your entire investment. You're at zero. Meanwhile, the mortgage is still $200,000, and the bank doesn't care the house is worth less. An S&P 500 index fund can drop 20% too. It has. It will again. But here's the difference. You don't get a margin call in an index fund you bought with cash. You just wait. The market comes back. With a leveraged rental, a downturn plus a vacancy plus a bad tenant can cascade into real trouble real fast. Here's why this matters. Real estate returns look incredible in a spreadsheet because leverage magnifies the upside, but it also magnifies the downside, and most people only plan for the upside. There's one more thing I found in that spreadsheet, and it's not a number. Liquidity. Stocks are liquid. You click sell. Cash in 3 days. Real estate? You might wait 6 months to sell. You might pay 6% in commissions, $15,000 on a $250,000 house, just to get out of your own investment. And here's what hit me hardest. Real estate ties you to a place. Job offer across the country? Your rental property is still here, with tenants, with a mortgage, with a roof that might leak next week. That's a constraint on your life that doesn't show up in a return calculation. Stocks give you freedom. Real estate gives you an anchor that might be an asset or a liability depending on the year. Here's why this matters. The best investment isn't the one with the highest theoretical return. It's the one that fits the life you actually want to live. So who wins? After 2 years of running these numbers, here's the honest answer. If you want maximum raw returns and you're willing to treat your investment like a business, active management, finding deals, dealing with tenants, real estate can absolutely beat the stock market. Leverage is a legitimate edge. But if you want to set it, forget it, and wake up in 30 years with close to $1 million, zero phone calls, zero emergencies, zero leverage risk, the stock market wins. By a mile. And here's the secret most gurus won't tell you. The real wealth move isn't picking one. It's doing both. Real estate for cash flow and leverage. Index funds for compounding and simplicity. They're not enemies. They're two tools in the same toolbox. Here's your checklist. Write this down. 1. The real estate advantages, leverage. $50,000 controls a $250,000 asset. That's the multiplier. 2. The stock market advantage is compounding plus zero effort. No tenants, no repairs, just time.